Transactional profit methods examine the profit earned from a transaction rather than the price or gross margin. They make up the vast majority of transfer pricing analyses done in practice. The transactional net margin method, or TNMM, compares the net profit margin that the tested party earns on a transaction to the net profit margins earned by comparable independent companies. The tested party is typically the simpler of the two parties in the transaction, the one that performs routine functions and bears limited risk. If one party is a sophisticated entrepreneur that owns valuable IP and bears most commercial risk, and the other is a routine contract manufacturer, the contract manufacturer would be the tested party. The profit level indicator, or PLI, is the financial ratio used to measure profitability. Common PLIs include operating margin, return on costs, the Berry ratio, and return on assets. You choose the PLI based on the nature of the transaction and the functions of the tested party. Once you've selected the PLI, you search for comparable independent companies using commercial databases. The most common are Bureau van Dijk's Orbis, TP Catalyst, or Capemine. You calculate the PLI for each comparable over a multi-year period, typically 3 to 5 years, and determine an arm's length range, usually the interquartile range, from the 25th to 75th percentile. If the tested party's PLI falls within the interquartile range, the transaction is arm's length. If it falls outside, an adjustment may be needed. The profit split method is fundamentally different. Instead of evaluating one side of the transaction in isolation, it looks at the combined profit earned by both parties together and splits it in a way that reflects what independent parties would have agreed. The profit split is appropriate when both parties make unique and valuable contributions, such as when both contribute important intellectual property, or when transactions are so highly integrated that they cannot be evaluated separately. There are two main approaches: contribution analysis, which splits profits based on relative value of each party's inputs, and residual analysis, which first allocates routine returns and then splits the remaining residual profit.